Hey everybody, today I wanted to talk about mutual funds, and I want to talk about mutual funds from the perspective of a fruit basket. So let's say we want to be an investor slash bodybuilder. Let's see, can I draw it? That's supposed to be an arm. Got some muscle. Cool. So basically, if we look at mutual funds, should write over here, we have a fruit basket, okay? And basically, within this fruit basket, you have, let's say, an orange, you have an apple, you have a banana sticking out over here. Say that's a banana. This guy, that's our banana. And then you have, what else? Let's say you have an apple. Oh, we already have a red apple. So let's make a lemon. And lastly, what's another nice fruit? Pear. So I'll put the pear over here. It's kind of like oblong shaped. All right, so you have your fruit basket, and that is individual stocks. So let's say the banana was Coca-Cola. Let's say the lemon was Microsoft. Let's say the apple was Apple, the company. Let's say this was Mercedes-Benz, if that was listed. I don't know if it's listed. And let's say the orange is Nike. So you have a bunch of different companies in this one fruit basket, and the mutual fund is basically you're taking a portion or percentage of everything that was over there. So basically you have a little bit of the pear, you have a little bit of the orange, maybe you have like half the orange, almost like that. Is that okay? Half the orange. You have a little bit of the lemon. Let's put the lemon over here. You have a slice, you have a portion. Let's say you have a couple pieces of the apple. So you got a couple pieces of that, a couple pieces of the apple, and then just a little sliver of that banana. So basically, you have one share or small portion of all of that, all of those companies. So it's basically one piece of part of that basket, which one, it allows investors to participate in a wide variety of investments. So like we see here, you have Coca-Cola, which is in the drinks and beverages industry. You have Microsoft, which is IT, blue chip stock. You have Nike, which is apparel. And you have cell phones here. You have different companies, different stocks. So you have a higher likelihood of, I guess, doing well in these different industries if these are very good stocks to pick in those industries, not just focusing on Mercedes-Benz and Ford and BMW, but you're diversifying your portfolio. So a diverse portfolio, let me put a little tick here so we know that's a good thing. Diverse portfolio, and that's let's call it a platefolio. Hey, diverse portfolio equals lower risk in gains or losses plus impact small if one company does bad. So basically, let's look at the alternative. Let's say you had the same fruit basket, but your platefolio was basically just apples. You pretty much took the whole apple. You put all your money into an apple stock, and you thought the iPhone was the best, and it was gonna last forever, and everybody loves the iPhone, and your favorite celebrity has the iPhone, so it's the best company to buy. It's gonna grow in value over time. But let's say Apple, something happened with the iPhone Z. So the iPhone Z went down, it was a bust. So basically, let's say Apple stock, which maybe you bought it for $50, is now worth $3 because the company got some bad ratings or some bad reviews. So the money is all in your Apple stock, but Apple's not worth as much now. Now it's only worth $3. Whereas if you only had a portion of Apple stock, which is here, it lowers the risk. So if these guys go down and they're not making as much, you still have these others in your portfolio that are going up and are doing well. So it kind of balances the scale, and the impact is small. The impact of this guy, maybe I should draw a dotted line. The impact of the Apple stock being bad is very small. So that's a benefit of investing in a mutual fund. You get to participate in the gains and losses. It is also, where's my pen? Let me underline this because this is very important. Diverse. Diverse is a very important word. So also run by fund managers. So basically, these people try to get you the most return for the money you put in. So it's a great thing that you have trained professionals making these stock picks and picking asterisk here, picking what goes onto your portfolio. Make good picks. And then also a benefit of having a mutual fund is that some of these companies might have, let's put a D for some of them, for the lemon and the Coca-Cola, they may have dividend. Do we have room? Dividends, which are money paid to shareholder for owning that stock. So basically we had Coca-Cola over here with dividend and Microsoft. So this lemon is just that one piece, but it's giving us many little pieces along the way, which is really awesome. We're getting some dividends. See like little plus signs. And then Coca-Cola was the other one, which is the banana. That's also giving us many mini payouts while we still have the stock. We haven't sold the stock. We just own it, and part of the benefit of owning that stock is that they pay out dividends. When the company does well, you do well. So they give us little pluses, little tokens of appreciation in our bank account for owning that stock. So basically, didn't really tie that in too well, but in terms of being a bodybuilder, if you want to get the most nutrients on your plate, you don't want to just eat bananas because bananas supposedly, you got some veins. Bananas supposedly, you got a little six-pack. You don't want to just eat bananas because bananas give you potassium. You need more than that. You don't want to, for example, eat just oranges because they give you protein. You need more than that as well. You need some essential oils. Maybe that comes from a lemon. In terms of a bodybuilder diet, you need a variety. Whereas, let's say, variety, you need a diversity, you need a mixture, which is what we have here, of different things, small pieces of different things, so that you have the best chance of building muscle and getting super, super strong. So that's been a breakdown of what a mutual fund is and how it works. Basically, key points are: it allows investors to participate in a wide variety of investments from different industries, be it tech, be it food and beverage, be it cell phones, be it clothes. A diverse portfolio lowers risk in your gains, and there may be some losses. In your gains, it's great to have the right picks, but if you have the wrong pick, let's say it was Apple, and it goes down, luckily you have others that are going up in different industries that are making your plate healthy, diversified. So it's also run by fund managers that try get you the best bang for your buck. So they make good picks more times than not, but you're free to make your own picks. And lastly, they also yield dividends, which is money paid out to the shareholder, you, for owning that piece of stock. You don't have to sell it. You just have that stock and they'll pay you these little dividends each time whenever they release that money because you are a shareholder of that stock. Some examples of really cool apps or resources to use for mutual funds would be the Stash app. This is not a plug, which I personally used. It's very cool. You could just start investing with a minimum of $5. You have the Robinhood, app, which I believe has no fees. So that one has 0 fees, $5 minimum. And I believe there's one called Acorns, which connects to your checking account and just rounds up. Let's say you buy a chocolate for $2.43. It'll round up that number to $3, and the 57 cents that was 57 cents that it took, it's going to invest that money for you. So those are 3 really cool apps to check out on your cell phone: Acorns, Robinhood, or Stash app. And this has been your quick rundown of mutual funds. See you later. Don't forget to buy the wristband. Woo. And live like others won't now, so that you can live like others can't later. Thanks, guys.